we're back to where we started before CPI rattled these markets this week. And there's not really that much left on this calendar, but for U.S. consumer confidence data tomorrow, we'll see how that goes. But since we talked about that yesterday, definitely check out the on-demand episode if you haven't caught up. Today, we're going to look to next week because it is a holiday-shortened week. We're off on Monday, of course, when markets are going to be shuttered. Back on Tuesday, so you'll get macro money then. But then Wednesday and Thursday, we are off again. And in that time, we are going to get some very critical data releases. And so what we'll do here today is look ahead to those and catch up with the news flow so that when we then come back around to the start of March the following week, we already know what's going on. So I am, of course, talking about February's Purchasing Manager indices. We're going to get them next week for the U.S. We're going to get them for Europe, and we're going to see what they all mean. This is, of course, Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and our mission here will be to figure out what this data is looking like, what it is likely to mean for investors, and then what trades there are to be had in the outcomes. So let's begin here, of course, with a conversation about the PMI numbers out of the U.S. because they have proven to be an absolute watershed moment for markets. This is a really great example of a piece of economic data that need not be so dramatically impactful when it comes out in order to have tremendous insight that then sets the stage for what happens and for what really drives markets thereafter. So let's take a look and see what we are looking at. And of course, the story that we're going to weave here will be a story of divergence in economic outcomes, divergence in monetary policy servicing those outcomes, and the consequences for trading financial markets from the outcomes that emerge. So the U.S., as promised, is where we start. As we can see here, the expectations for February's numbers are not terribly removed from January's numbers. So here are the forecasts. You can see here just a touch softer on services and the composite index here in the expectations, and really truly a touch softer. The composite index seen coming in from 52 to 51.9, barely changed at all. Why do I say this is a watershed? Well, the January numbers, that's these right here, where you see manufacturing pop back over 50, which in the logic of PMIs is the threshold between contraction and growth. Readings above 50 mean the given sector, services, manufacturing, or the composite, see expanding economic activity. Below 50 means economic activity is shrinking or contracting. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we're seeing here is that in January, manufacturing came back to growth. There was a strong pickup in services. All that amounted to a very significant uptick in the composite index. And most importantly, that uptick, wholly unexpected. The markets were looking for standstill. They were looking for things to slow in January as relative to December. And there was a dramatic beating of expectations. As it happens, this proved to be the point at which U.S. economic data started to recover in brisk fashion relative to forecasts. And what have we seen thereafter? The PMIs were the tell. They were the first. Thereafter, better GDP data, better NFP data, hotter CPI data, hotter jobs openings data. One after the other, the big headline indicators crushed expectations. And of course, we have a favorite chart to capture this. This is Citigroup's Economic Surprise Index. We look at this all the time here on Macro Money. And this right here is where that December PMI data comes out. And of course, thereafter, we see the U.S. economy increasingly accelerating relative to forecasts. So economists' bets on what the U.S. economy is going to do clearly too pessimistic because the data keeps beating them, and by a widening margin. That, of course, helps to explain all of the price action that we've seen in markets since then. Here is the most important part of it, I would contend. In the gray bars is the outlook for Fed rate cuts as it is implied in Fed funds futures for this year. That's the spread between the start of the year and the end. The spread and the implied rates, of course. And what that's telling us is we have gone from just about 6 cuts at the start of the year, about 150 basis points, or 1.5%. A standard size cut is 25 basis points, or 0.25%. So if we have 1.5%, that's 6 moves of 0.25% or 25 basis points each. That's where we were at the start of the year. We have now trimmed this to about 80. So we have shed more than 2 cuts from this outlook. And because we've shed them with U.S. economic data getting better, not worse, so the message isn't, oh, you are going to regret this economic data, because what's going to happen is the situation is going to be such that markets fall because they feel like the economy is weak, and so they need more cuts. They want more cuts. That's not what's going on here. Instead, we are having the economy look stronger, and the markets have ostensibly concluded, well, in that kind of an environment, you don't need as many cuts. And so, whereas last year, what we saw, especially in the second half of the year, was when rate cuts diminish, stocks fall, and when rate cuts expand, stocks rise. Look at what was happening to economic data at that time. From mid-year through to the start of this year, U.S. economic data is deteriorating relative to expectations, which is to say, markets are saying, well, the data is undershooting. What do you mean fewer cuts? That's not good news. We want more. The economy is in a bad spot. It's trending the wrong way. Well, now it's not. And the PMI data was really the point at which that occurred. So what we're looking at here now is diminishing rate cut expectations and stocks powering higher all at the same time. Now, how long this is sustainable, that's a wholly other thing. Obviously, at some point, analysts' models do get adjusted and start to line up with expectations closer. And needless to say, both the expectations and the markets themselves are moving in real time. And so what you're doing here is essentially playing chess on a liquid surface. This thing never actually stops in earnest. The adjustments are perpetual, but at least at the moment, it looks like U.S. economic data is not only continuing to beat, but is beating by a widening margin. Hence the rise in this index. And so what we are seeing then is a setup where this data, with expectations of about anchored here, runs an asymmetric risk of surprising higher. And if it does, that ostensibly means more rate cuts come off the board. Now, whether that's good or bad for stocks, we shall see. We saw this movie before. There was a strong upswell in U.S. economic performance at the start of 2023 as well. And of course, we know how that ended. Eventually, that gave us high enough rates that something got punctured in the credit structure, and we had a banking crisis led by the likes of SVB and Signature Bank and First Republic, and a forced marriage between UBS and Credit Suisse. So there is perhaps a pain point here. But where this isn't working in strange and mysterious ways, where the relationship changes, is the currency market. And as we saw yesterday, what this shift in Fed policy odds has done in spades is it's given us a stronger US dollar, pretty much across the board. Now, when we turn to Europe, the situation is pointedly different. And one of the more interesting moments in the global economic data cycle is that when you get these PMI numbers, you get on the same day the US, the Eurozone, and the UK, and Australia, and Japan, all in a matter of hours. And what we're going to focus on here isn't so much Japan, where there's very little chance of meaningful policy change of any kind this year, or on Australia, where you have a relatively modest outlook for policy change, and really zone in on Europe, because this is where the divergences, at the moment at least, appear the most acute. We'll start with the Eurozone. Now, the first thing you notice here is that you have all of these indices below 50, which means that in the Eurozone, if you're not calling it a recession yet, you might as well be, because things have been shrinking for 8 consecutive months. You have more of the same expected for the February round here. Manufacturing below 50, services below 50. Needless to say, that gives us a composite index below 50. So what we're looking at is an economy unlike the US that needs easing, seemingly much more so than the US does. Now, that same surprise index here seems to be pointing dramatically higher. And so the expectation is, well, maybe we will get much better than expected data, and maybe that will give us an adjustment toward a more hawkish view. Maybe so, but it's important to remember this is an index in relative terms. It's not about data outcomes as such. It's about those outcomes relative to forecasts. And so it is at this point that we look at where the forecasts have gone. And what we find is that from about mid of last year, it is most dramatic, of course, for 2024, because that's the closer period of time. The outlook for 2025 hasn't really moved very much at all. But what we certainly see is that the bar for economic data to beat has been lowered significantly, because the expectations for growth have been downgraded significantly. And so you can see here from about July, August, there is this significant reduction in Eurozone growth expectations, and shock of shocks, from about July, August, this thing starts to move significantly higher, because, of course, it is much easier to clear the bar when you lower the bar. So this does not seem to be particularly good news. We may get better than expected data, but it's still likely to leave us in much worse shape, indeed in contractionary territory in the Eurozone. Now, as far as policy bets go, we already see that there is more easing on the menu than there is from the Fed, and things have moderated a little bit. We've gone from about a similar outlook to the Fed, 6 cuts at the start of the year, to now just 4, 1%. But if this data is going to be soggy again, well, then there's at least a bit of room for this to expand back out. The weaker the data, the more the ECB looks like it needs to make its move. This is doubly so, it would seem, if the Fed has lost the appetite for immediate easing because the US economy has become hotter. Indeed, much of this correction hasn't happened because the ECB has really changed its mind one way or another. It's happened because the Fed has. Global borrowing costs are largely driven by the Fed because most global economic activity is transacted in the US dollar. According to the Bank of International Settlements, close to 80% of global monetary transactions are settled in USD. So when you get this kind of a shift, at least part of that shift isn't even happening in Europe. It's this shift in the US, because as you get higher yields and fewer rate cuts in the outlook in the US, that same response echoes across markets, and you see it here. So that this has come down isn't so much a testament to the Eurozone economy doing better, it's more so a testament to the Fed moving global yields higher pretty much across the board. But when this data comes out, what it is likely to reinforce is that the PMIs, and therefore the growth story, is going one way in the US and the polar opposite way in Europe. And so while you've already opened up about a 20-25 basis point gap here, there's perhaps room for that gap to widen. And so what you're looking at then as a consequence, if in fact what you've been looking at is a situation where stocks are doing this or stocks are doing that, but it's currencies that are responding to the macro in a clear and unambiguous fashion, then you'd be looking for the dollar to strengthen against the euro. And as it happens, you find yourself in a very advantageous point to have that view. Now, of course, this is already a move that's underway. But what you've seen is the up move that we saw in the fourth quarter of last year, as those Fed rate cut odds were building and the dollar was getting slammed, that's been overturned. The trend down has now emerged, and we find ourselves, after a bit of a correction, right at the decision point here. So we're retesting this former spot. Support now become resistance. We're at the bounds of the move lower right here. Of course, a move down is defined by a series of lower highs and lower lows, and we are right there at the moment. So if we were to find an opportunity to sell, it might be here. And granted, you don't have technical confirmation at this point that you're going to break above this level, and we are looking at data that's coming almost a week from now, so lots of things could happen. So one way you could get exposure here is in a risk-defined way through an options spread, and essentially say, okay, well, if I'm going to take a position here before there is technical confirmation of a reversal, I could essentially buy a put spread and look at it that way, in a risk-defined way, and basically say, I'm willing to lose, let's say, 1 or 2% of my account on this not working, but not more, and then cap it there. Because certainly the risk reward when you're nose up against resistance to be selling into an emerging down move with ostensibly support from the fundamentals is pretty good here, in my view. Now, It's perhaps an even more dramatic story in the UK. Here, the economy is not nearly as battered as it has been in the EU. But what there is here is a change in trajectory that is still much earlier, much younger than what's happening across the English Channel. As we mentioned, the EU has been in contraction territory for months and months, 8 to be exact. In the UK, we are just starting to see the cracks really present themselves, again, in relative terms, because at the end of the day, that's what matters here. It's not that we've seen acute economic weakness in the UK, that much we know. It's the direction of travel. And what we see is that into the end of last year, there was a pointed pickup. Manufacturing is still in contraction territory, but less so. It's shrinking at a slower rate. And the expectation is that in February, that rate will slow further. Services, of course, is still the main component of the economy. Most major economies are about 20%, give or take, manufacturing, then about 70%, give or take, services, and the remaining 10% is, and we're rounding very liberally here, is ag, so the farm sector. What we're looking at here then is seemingly a slight slowdown. But the surprise index here could not look more ominous. And of course, that's exactly what we've seen from the recent data this week. Just in the past several days, UK CPI disappointed, giving the pound one shot in the ribs, and then GDP disappointed, giving another. And the pound is not looking all that great thereafter. It's been moving lower following both of those releases. What's worse, as we just looked at with the Eurozone, if we had a situation where the data was disappointing because expectations were increasing, well, then you'd say, okay, hold on a minute now. You're raising the bar. Of course, it's more difficult for the data to beat when you've raised the bar. But when we look at how the expectations have evolved over this period, the bar has not been raised. It's actually been lowered. More modestly than what we've seen in the Eurozone situation. But nevertheless, we are seeing economic data not only miss, but we're seeing it miss as the bar is being reduced. So the expectations are not as lofty, and we're missing them by an increasing margin. So the situation seems to be very quickly devolving in the UK. Now, the path of policy expectations, again, very similar to what we see elsewhere. We had close to 6 cuts at the start of the year. We've hemmed that in to about 65, 66 basis points. So we're looking at 2 cuts at 50 basis points in total and a bit of optionality on a third. But if this data keeps going this way, then what we're looking at is a reassessment. If this PMI data starts to look like it's going to fall in with the trend that we see here, well, then it's likely to disappoint. And then the outlook for rate cuts here is likely to significantly expand. So this is perhaps the place where there is more to do. There's perhaps more of an adjustment to make than there is in Europe, where, frankly, things have been anemic for quite a while. And when we look at the chart, it's a similar sort of conclusion that there is to make. Whereas the euro, we can see here, is already in a move lower, the pound is in a range. Now, it's down a bit, as we said, after the PI and GDP numbers that we've seen, but it's still largely holding the bottom of this range here. And so what we are going to look at here then is a situation where we have a very clear trigger point here, right around, let's call it 124, 50, 125. That band that we see there, right around, let's call it something like a support level with depth. So rarely is support and resistance an actual straight line. Rarely is it just one level. It's usually more like a range of some sort. And so if we look at this as basically saying, okay, we have a range here from about, let's call it 125 to about 125.50, give or take, you'd look for the data to disappoint and crack that barrier. And if you do, then you open up room for further downside. Very tellingly here, we had a narrower range. We tried to break back into it, and the data didn't allow it. We pointedly failed and crumbled back toward the bottom. So the makings of a rounded top and a reversal lower seem to be appearing. And if the PMI data comports, follow through may well be next. And that is macro money for today. As ever, we're typically here Monday through Thursday. It'll be a special week next week. We're only on for Tuesday, but the following week we will be back. I'll be on Futures Power Hour tomorrow as per the usual, and then the week after next, that is going to return. I'm also writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Happy trading. See you next week.